want to welcome everybody to our webinar on short and long-term financing. We have a couple of industry experts joining me here, and we're going to be doing a deep dive on some topics here and getting some perspectives from these experts. I first want to start off by giving an introduction, and we'll go around the room here, so to speak, with introduction. I'm Doug Perry. I'm the Director of TPO Sales for Templeview Capital. Templeview Capital is a leading private money lender. We lend money nationally. We do short-term loans, fix and flips, ground-up construction, bridge loans. We also do long-term loans, 30-year fix on single asset rental properties. We can do purchases, rate and term refinances. We even do long-term financing on short-term rentals. You can put a 30-year fixed rate loan on an Airbnb. With that, I'll kind of go around the room here. Scott, give us a brief intro on yourself and what you do.
All right. Yeah, I'm Scott Rosenhaus. I've been in the industry for 27 years. I'm one of the partners with Cory Nemoto with Keco Capital. We are the fund that never sleeps. My team's based in Florida. Cory's in Hawaii. So when he goes to sleep, I'm up, and vice versa. So we're all about service, and we have every program under the sun, from ground up, fix and flips, bridge loans, long-term, short-term, and we believe in service. You ever need a proof of funds letter, we're there for you. If you ever find an Airbnb, which we do a lot of in Hawaii, great program we have. We can give you an Air DNA, make sure that it works. If a loan doesn't work for the borrower, we're not going to do it. And we're about building up relationships, not doing loans. So I'll pass you on to my partner here, and I'll give you a little bit of our culture and what we do in Hawaii.
Cory, it's all yours.
Well, thanks, guys. I'm Cory. I'm co-founder of Keco Capital. We're a private money lender, as Scott mentioned. I started my career out on the investor side, so I still, to this day, have millions of dollars in private debt to my name. And every time I say that, it's kind of cringy, because people are afraid of debt, right? But obviously, there's a difference. We're all here that there's a difference between good debt and bad debt. So I'm a borrower as well, but we've also, in the last few years, with a lot of help from people within the industry, we're able to launch our fund and lend privately against real estate as well.
I'm Peter Christiansen. I'm the co-founder and managing partner of Builders Trust Capital. We're also a private money lender. We're based on the East Coast, out of New Jersey. We do short-term loans, which we do really now local markets. So that's on the East Coast, New Jersey, Pennsylvania, Maryland, DC, Virginia, and Florida. We do fix and flip loans, bridge loans, new construction, and then we do also long-term financing, and we do that on a nationwide basis. We'll do short-term rentals, long-term rentals, and purchases. So I was also an investor myself, part of founding Builders Trust Capital. I spent a lot of time in the financial services industry in New York City, and now manage a fund where we lend out money to real estate investors.
Outstanding. As a reminder to our audience, we will be recording this, and if we have time at the end of this, we'll have an opportunity for Q&A sessions. We have the emails of everyone who registered, so we'll be sending out a link to that recording when we're. With that, let's go ahead and dig in. There's a lot of red hot real estate markets across the country. It's creating opportunities for investors, and it's also creating some challenges for investors. Let's kind of go around the room here. Peter, I'll start with you. What are you seeing in some of the trends that are occurring in business purpose lending, where you're making loans to investors? What is the way that the industry has adapted to some of the demands that investors are requiring right now?
Sure. I think one of the key things is that it's becoming a lot more competitive, I think, as a lender. So if you look at the real estate market kind of right now, I would say it's very much a seller's market. I think maybe on the investor side, it's very much a borrower's market. I would say there's a lot of options compared to a couple of years ago, both on the DSCR side and the short-term side. So I think just generally speaking, in the financial environment right now, there's not a lot of yield. So I think as a result of that, there's a lot more institutional money, Wall Street money flowing into the private lending space, which is compressing yields, making loans more aggressive in terms of leverage and things like that. So I think overall trend that I'm seeing is that it's becoming much more borrower centric, if you will. So lenders are having to become more competitive, both in terms of the products they offer, the rates they offer, and the leverage they offer.
Good news for borrowers, lower rates and better products.
For sure.
Scott, Cory, anything you want to add to that? What are you seeing on your end of it? And we're kind of all around the Cory's based over in the Hawaiian Islands. Scott's based in Florida over there. So we've got a good perspective on things on the West Coast also. What are you guys seeing? What do you want to add to that?
Much. What we've been seeing is a lot of people are doing fix and flips, but they're getting out of it. They're going more into the short-term programs. The Airbnbs are becoming huge nationwide, not just in Hawaii. We try to stay away from condo hotels, but it is a good product that is offered out there right now. The Air DNAs, and we'll run an Air DNA for an Airbnb anytime you guys want to make sure it makes sense to you. But that's pretty much where they're shifting gears right now, because it is tough to get products sometimes for the fix and flips. So getting products and not wanting to be able to flip them so quickly these days, they've been going into long-term rentals or short-term rentals.
The cash flow we're seeing on some of those short-term rentals is really attractive. And when you're seeing investors that are challenged to the long-term rental market, those short-term rentals oftentimes do work. Cory, any thoughts?
Yeah, I like Peter said, I feel it's definitely a strong seller's market across the nation in most markets. And it's kind of like a huge battle with buyers, right? Even investors who are buying for commercial purposes. And I feel the industry has changed a lot on the financing side, where rates have gone down, leverages have gone up, and lenders are having to be very aggressive to compete for business, and which puts the investors and developers in a great position, right? So on one end, yes, it is a lot more competitive today to get into deals. But on the other end, you have great financing products out there.
Yeah, absolutely. Kind of dovetails on what Peter was saying, that a lot of institutional capitals come into the space, resulted in lower rates, resulted in higher loan amounts, more leverage, higher LTVs that you're seeing, as well as just more competitive and innovative products like you and Scott were talking about, the ability to put a long-term loan, a 30-year fixed rate loan on a short-term rental, just something that even a couple of years ago, you'd say, what are you talking about? You can't finance a short-term rental. No one can get their hands around it. Now they can get their hands around it really easily. All right, let's move on to something else that's within this. How are borrowers profiting in these red hot markets? Any ideas, team, on how people are sourcing deals? Cory, I'll go with you. You have these. We can pick on Austin, Texas, the #1 market where values seem like they're increasing, not just day by day, but hour by hour. And also that old axiom in our business: profits made on entry, not exit. It's just hard to do in a red hot market. What are you seeing out there, Cory?
Well, it's definitely definitely getting harder to get into good deals, and also it's a tricky point because I feel there is a big question mark on where we're going to be heading. There's so many different things going on within the economy that could affect the housing market eventually. The supply chain issues, we have inflation rates going up, and I feel that in this environment, it is hard to kind of see what strategy is working best, and should I pivot, to a different asset class. I think from what I've seen is that there's actually more action going on. I see a lot more volume, and I feel that it really depends. If you break it down to the fundamentals, that it depends on what market you're in, right? Because are you in a very strong equity and appreciation market, or are you in a very strong cash flow market, or maybe it's a mix of both, right? So Hawaii, we're a very strong equity and appreciation market because there's limited supply. We live on an island or islands, and so there's limited real estate already, right? And there's a strong demand because everybody wants a piece of Hawaii. So I think it's important in this environment to look at the market that you're investing in heavily, maybe it's your backyard, and try to break it down to the fundamentals of what's going on in the market. Because if there is a correction in the market, I feel that it's not going to happen everywhere, and some markets may actually boom. During COVID, right, there was a mass exodus from cities like New York down to Florida. So, and I don't know if that's just temporary, right? It seems so. So I think looking at the market that you're playing in and what environment it is the first thing to kind of consider before diving headfirst into a new strategy if you're considering pivoting. But the environment that I'm seeing right now is it's very hot. There's still a lot of deals out there, and a lot of our clients, some of them, man, when we see them enter and exit, it's like, wow, bravo, congratulations, guys, that was a good one. So it's still, I feel, a very great environment to invest in. Just be careful what strategies you're using and in what market. Is it the best fit for the market that you're in?
Yeah, absolutely. We love those high loan amounts in Hawaii. And like you said, seeing some deals that are Bravo deals, it reiterates, know your numbers, be a student in the numbers, that's for sure. Peter, any advice you give to investors in trying to source deals? What are you seeing with some of your clients and some of the creative ways they're doing that and competing in these hyper competitive markets?
Sure. Yeah. So I think a couple of things is one is that I think it's a good idea to kind of adjust your expectations, right? So for instance, the good old 70% rule is not maybe realistic at the moment because of the values. So I think what we're seeing some clients do is that they're adjusting their expectations, and especially if they're buy and hold investors, they're okay maybe leaving some more cash in the property if they still think that the deal makes sense. So maybe it's not realistic getting all your cash out. So you get maybe most of your cash out, you get out what you can, but you're okay maybe leaving some money in there. So adjusting their expectations. I think the other thing is that a lot of our clients are being forced into maybe taking on deals where there's more forced appreciation through, either construction or repositioning of assets. So for instance, in the Philadelphia market, maybe you take a single family property and turn it into a triplex. That involves obviously potentially some zoning approvals and things like that, which could be a little bit tricky. But again, you're kind of having to force that appreciation. The really super easy cosmetic fix and flip where you're in and out in 6 months and you make a decent return. Those deals, I think, right now are hard to come by. And again, just in terms of adjusting expectations, that is not realistic. So I think for newer investors going in with like eyes wide open, you're not going to maybe hit a home run right now. So being well capitalized, knowing your numbers, like you said, Doug, and like you said, Cory, I mean, that's super important, right? Sometimes the best deal is the one you don't do, right? Especially if you're starting out, don't force it. We talked about leverage being higher, rates being lower. You can do a lot of kind of financial engineering, but it's almost like if you look at a deal and you want to, or a stock, you want to unlever the beta, like look at the deal without the leverage and make sure that it still makes sense, and don't try to force it just because, we're lenders, but still we want what's best for our borrowers, right? Don't try to force a deal just because you can get cheap money. So, and then I think just one last thing is that we're seeing a lot more, I would say, like dirty title deals. So, be careful, right? We do a good job underwriting, I would like to think. So we catch a lot of that stuff, but we're just seeing a lot more, clouded titles or, inherited properties that might have some issues on the title side and things like that. So if they can be worked out, again, it's just you have to take on more difficult deals, I think, in this environment. But just, go in, eyes wide open with realistic expectations, and then you should be able to do okay, I think.
Yeah, makes sense. I think in these red hot markets, you're seeing a lot of owner occupants being willing to take on those cosmetic deals, bumping out investors, and what's left for investors are complex deals. That's for sure. Scott, shifting a little bit, we've talked about how borrowers and how investors are sourcing deals. How are they financing those deals? What are you seeing there in terms of what's happening in the industry?
Much. A lot of these borrowers, there's a lot of appraisal issues out there that are taking forever outside of Hawaii, they're paying cash for these deals, and cash is king. So what we've sourced out now is delayed purchase, where we'll give them back up to 90% of what they paid in cash for the first 6 months, as long as there was no renovation done on it. So that's where they're sourcing that in, and we'll give them 100% of the renovation. So this delayed purchase program has been a great way for them to source their deals from now going forward. And also we'll build a lot of the renovation budget into the loan, like you give advanced draws. So we give 100% financing and we'll give advanced draws towards it. So this way they can hold on to they hold on as much cash as possible these days. That's my advice I always give people. Cash is king these days.
That ability to get advanced draws, definitely something good, and really to kind of connect the dots here. Lenders out there want to be very helpful in the numbers. We've talked about understanding the financing options, understanding the numbers. We're eager to share those numbers with you. We're calculating them behind the scene, and we're eager to share them with you to have them. Cory, expand on a little bit, and maybe you can go into the appraisal part too. Are appraisals causing any issues for lenders, for borrowers right now?
Yeah, I would say that one's an easy one. It's causing issues. The appraisals are in short supply from what, our experience across the nation. The lead times are taking longer. They're starting to get more expensive. So we're in an environment, again, that's hard to predict, right? So I don't envy their job. But at the same time, I think it's prime for disruption soon if things don't change, because companies like ours, and I'm sure Peter's and you, Doug, it's like we can't stop, right? And if anything, like for our clients and investors who are looking to make get into deals, you need to move quick, right? We all know. And if that's the case, then appraisals are kind of a big problem for us right now. But I think we're working on ways to put things in place to hopefully expedite that process.
I think from the lender side and the capital side, there's a couple objectives. One, we want to make sure we understand the accurate value, both of what the collateral is worth now and what it's worth in the future, the after repaired value. So we want accuracy, but we also need to do something to speed things up. We could probably spend an hour alone just on the appraisal issue, but the bottom line is there's just not enough appraisers to meet the demand. So everyone's going to have to get creative. Probably a good time for some technology to come into play. Some of the government-sponsored entities, Fannie and Freddie, have been amassing an incredible amount of data on valuations they use internally to come up with an internal valuation model. And it's time to start spreading some of that data and make those models available to everybody. I think you're also going to see lenders get creative on their own and be innovative and come up with some models to accurately value things without the time delays of a traditional appraisal. Let's kind of move on here to our next topic here. Let's pivot to build to rent and ground up, two things that a typical investor might not look at, but with the booming demand for housing, you're seeing that demand for rental units be underserved. And you're also seeing opportunities where profit might not exist in a traditional fix and flip, but it does exist in a ground up type of project. Scott, why don't you kind of take us through that? Are you seeing any action in that build to rent or ground up space?
Yeah, the ground up space is starting to boom, especially in the Hawaii market. The only thing I can give advice to is try to have your permits in place prior to getting a loan. Like we can lend up to 65% of the land and 100% of the vertical. And if you own the land already, we'll give you the 65% added to give you back as cash in your pocket. Again, cash is king. So ground up has been huge, getting bigger and bigger. Cory can either, piggyback on me on that one. But Hawaii has been huge in ground up, and I see it in Florida also. We're getting it across the country, slowly coming across, but it started in Hawaii for us, and it's been a big product.
Yeah, for us, we've seen ground up is definitely we're getting a lot more requests for ground up in markets like Hawaii. It's hard to cash flow here, so most of the exit strategies are to go to market and sell. But in other markets where maybe the price tag isn't so much on the land, then the numbers work out where, yeah, I mean, if you can build ground up and then still have enough room to come with a takeout loan on the back end for, some perm financing, then and still cash flow, I mean, I think that's a great strategy.
Yeah, absolutely. Right. And especially some of those projects where you can repurpose to the highest and best use. Got a property, a large property or larger where there's a single family, tear that down and put in a 4-unit, and that becomes the highest and best use. Peter, what are you seeing on your end of things with that ground up, the build to rent, that side of it? Are you seeing any action with your company?
So I think similar to Cory, I mean, most of our bars that do ground up, they flip them or they sell them, right? So the New Jersey, PA, Eastern PA markets are, fairly high value markets and fairly expensive to build on a per square foot basis. So I think economically in the numbers, I think that's different in markets like Florida, for instance, where you can build cheaper. So I think in markets like that, I personally love the build to rent model, right? I mean, you're not going to have a lot of capital expenses the first probably 10, 15 years if you're building new. So from a rental standpoint, it makes a lot of sense. But most of the ground up that we're financing is, the exit strategy is a sale. What I would say too is this goes back to a little bit about finding deals in a hot, difficult market, right? Is that, you can take on ground up as opposed to a flip. And, I think the risk is different in that you're not going to find something you didn't know behind a wall once you start the renovation, right? Like you would maybe on a flip. But to Scott's point, making sure that your project is shovel ready by the time, I mean, ideally when you buy the land, but if not when you buy the land, then when you take on the financing, because you don't want to sit on a project once you have the loan, right? And the risk that exists with ground up that doesn't exist with a fix and flip is that you want to make sure that what you're trying to do can actually be done, right? So to your point, Doug, is if you think you want to build a triplex or a quad, but it's really only zoned for a single family, you don't want to learn that after you buy the land and you present your plans, and that's too late. So you should do a lot of due diligence before you ever sign a contract, before you ever commit to a deal like that. But I think ultimately, they could be great deals, but you have to be careful, and it's a different level of risk. I don't necessarily think it's a bigger or smaller risk than a fix and flip. It's just different, right? So it comes back to experience, which is something we value highly as a lender. Is that if you've done it before, that's a huge plus for us. If you've done it 10 times, it's a even bigger plus. And you just have to, again, eyes wide open, know what you're going into and know what risks that you potentially would be facing.
That's a really good point. I think that 2 points I'd like to make on that. One, ground up is not for newbies. Do not start a ground up project. It's for experienced investors to do. You're just going to get your lunch handed to you if you're a newbie doing a ground up. It's not going to be a profitable project. And the other part, Peter brought up a really good point about entitlements. You got to make sure you're entitled to build what you can build there. That's different than getting plans and permits. Plans and permits is a lengthy process, oftentimes expensive. An entitlement is where you get a letter from the building department saying, you're entitled to build this. You're entitled to build a single family residence up to 3,000 feet here. Please submit your plans and permits for approval when ready, and make sure that you're entitled to build what you want to build there before you ever buy a parcel or property. Don't trust the seller. Don't trust the seller's agent. Do that research yourself. That's just a basic premise. Really good point. Let's shift to a different segment right now of business purpose lending. And that's short-term rentals. STRs, we call them in the business. Those are the Airbnbs, the VRBOs. Cory, let's go to you. What do you see in that, and what options are out there for investors to acquire these and finance them?
So yeah, it's definitely a space that's opened up tremendously. I was totally wrong at the start of COVID, especially here in Hawaii when they're shutting down travel. When they shut down the airlines to Hawaii, I thought, that's it, guys, brace for impact. It's time to earn our stripes, but I couldn't have been more wrong. So there's a big question mark over my head. And, but what I have seen, shockingly, is that the Airbnb space and the short-term vacation rental space has just boomed, especially in markets like Hawaii. We even have people in Tennessee, who have vacation rental units out there, and the cash on cash returns that I'm seeing on their numbers is just outstanding. So I think there is a nice strategy to approach with the short-term vacation rentals. And now that what Peter was saying earlier, how the lending space has opened up so much, so there's a lot of institutional capital in, and there are options, like you said, Doug, that you guys have and we have for a short-term vacation rental for the 30-year, and so there is financing options out there now for investors who are pursuing that strategy. And I don't want to rewind too far back, but just because I did see one of a strategy that a couple of people are using for the ground up is that they get the land under option. Like they'll get like a lease option contract with the seller as they're pursuing permits and stuff with their consent, and then they'll come in and refinance. So it kind of helps mitigate the risk, for that. I've never seen anyone yet. I don't think we've done one. Scott, maybe you can correct me if I'm wrong, but I don't think we've done one for ground up with short term when the takeout was a short term vacation rental loan. I don't know if you guys have seen anything like that.
Not yet. We haven't had that one come up.
Right.
Yeah.
So
I would agree.
those
Typically
will
not
start
seeing
coming
a
up.
lot of ground up with the exit being a hold for a short-term rental. Most of those are acquisitions. You might do some rehab on that, but a lot of times those are luxury style homes in vacation resort areas with the price tags commensurate with that, so that you can immediately get cash flow. Oftentimes they might be buying a new build where they're doing it with it, but they're rarely doing that build themselves.
We're actually we just did that actually down at the Jersey Shore. So we're financing in Wildwood, as a matter of fact. It's a older building that they're tearing down and building, I think, 6 or 8 condos with the intention of, I think, selling. If it's 8, then they're selling 6 and keeping 2, and the 2 they're keeping, they would use as short-term rentals. So it's a little bit of a hybrid, but they're doing them as condos, so they have that flexibility. So interesting concept. But
the numbers should still work out, right?
Because, yeah, for sure.
Wouldn't be a loan on if the numbers didn't work out.
Right.
They can do cash, but I think a lender's going to get behind it without the numbers.
No, the numbers are terrible, but they still didn't. No, they're good numbers, and they're super conservative LTVs. Actually, I mean, again, it's kind of maybe full circle here, but they're being pretty creative in how they acquired the deal and how they are, everything really that they're doing about it and forcing that appreciation. So
makes sense. Scott, I'll direct this one to you. The question had popped up there and the question was what banks are doing short-term rentals. I don't think any banks are, but I know 4 people on this call that do it. You're looking at them, but Scott, tell us a little bit about where people can go and get these long-term loans on short-term rentals.
Pretty much. I mean, we're offering a program right now. The rates start in the 4s right now for the short-term, and it goes into the long-term. I mean, it's the same programs you get, Fannie and Freddie. I mean, we're giving, 10-year interest only, 30-year fixed, 20 years. It's across the board, and we're strictly, the DSCRs are low. I mean, so it's working for everyone right now. I mean, we have a very aggressive program. I know Peter has a very aggressive program as well. So, in Templeview. So, I mean, everyone here, we're on the same boat. We have 4 good lenders here that can 3 pretty much. So.
Exactly. It's really being served by that private money space. And as Scott said, you're getting Fannie, Freddie agency type rates without an agency type underwrite. That underwrite's based on the cash flow of the short-term rental. None of the people here are asking for tax returns. They're running internal models. Scott talked about it, an Air DNA that tells you what that rent is on that. So it's a relatively easy to get loan that doesn't have the agency, the Fannie Freddie type of DTI requirement. We're running a debt service coverage ratio, entirely different. It's only based on the rent. So you're getting the best of both worlds, an ease of a loan process combined with some hyper competitive rates. Anything you want to add to that, Cory?
Yeah, just with the Air DNA, like we always believe a quick no is as good as a quick yes. So if a borrower calls up, and we'll tell them right away within 24 hours easily if it's a good deal or not. Because we're not going to take a deal unless it makes sense to the borrower. So that's a great product that we have that we can just let people know. So
absolutely. Couldn't agree more, right? With the tools available and the expertise available, you're just by one quick call, email to one of these lenders here, you're getting some quick answers, you're getting quick response. You're dealing with experts right off the bat that are happy to help you. With that, I'm going to move on from short-term rentals into fix and flip. Tell us a little bit about what we're seeing on the fix and flip side now. I know that we've talked around it a little bit here in some of these things. Peter, I'll go to you. What are some things that people should look at there relative to getting loans on fix and flip properties and what's out there and what's available?
I mean, look, I think it's the same thing as we just talked about too, but there's lots of options, right? I think so. Rates are competitive, leverage competitive. So I think a lender should be part of your team, right? Just like, you have your contractors, insurance folks, realtors, make sure that, and I think we on this call at least all share the same kind of philosophy that, you want to do what is in your borrower's best interest. So make sure you choose a lender and make sure that you get referrals and do your due diligence in a lender just like you would any other service provider. But I guess overall, generally speaking, competitive rates right now, competitive terms, but again, be careful to not let the good terms of the financing make you do a bad deal. And then I think, as Scott mentioned earlier, and Cory too, and you, Doug, this service is important, right? So lenders, it's kind of dating, right? When they're courting you to try to get a loan, most lenders put their best foot forward, but what happens after you actually close the loan, right? So make sure that you're comfortable with the way the loan will be serviced, especially if it's a heavy construction budget, right? Make sure that you're going to get timely draws, that process is fairly straightforward and easy, and that you'll get your money when you need it, that kind of a thing. So just like any other part of the deal, do your due diligence up front and make sure that the lender is someone that you'll have a good working relationship with, right? Don't also, I would say, fall into the trap of just chasing the lowest rate and the highest leverage, right? It's more than that. I think some people in the space consider what we do to be a commodity. I personally disagree. I think there's much more to it than just, numbers. So that'd be my piece of advice is deep due diligence.
Makes sense. It doesn't have the same, our business does not have the same regulations as owner occupied. So if you're dealing with someone who isn't reputable, oftentimes what might be conveyed isn't what's delivered too. It's really important to have that relationship.
Yep.
Cory, what do you want to add to that? What do you see on that fix and flip side, and what advice would you give investors relative to sourcing financing, and what would make a successful deal?
I think Peter said it great. It's not just about the interest rates and the leverage, because most lenders out there are pretty competitive already. So we're talking about maybe like a 50 basis point difference, maybe, or a point here, point there. And when you compare it to the bottom line, maybe that's a few $1,000 at the end of the day. But I mean, if a point or half a point difference between lenders is going to kill your deal, then it probably wasn't a deal, in the first place. So that's the way I would think of it. And I've used private money and for my whole career, and we're in expensive markets, right? So that's why we have so much money in debt to our name. But that's why it's also important to make sure that whoever you're taking money from is like Peter said, more of like a partner or a team member by your side. Like I think all of us on the call here, our goal is to not just cut loans, and that's our culture is we don't just cut loans. We want to do good loans to good borrowers and clients that we can help them scale their business and be alongside their path and their journey and their career, for as long as possible, and watch them grow, and we grow alongside them. So, and when you have that backing with people who just genuinely want to see you succeed, and, will turn away a loan if they think it's a bad idea, then that's the type of person you want by your side. Because when things happen, like I was hearing stories when COVID happened and the liquidity kind of dried up in the hard money and private money space. People couldn't get their draws, because their lenders had to shut down. Some of them got, had margin calls. Some of them didn't come back. They closed their doors and did not reopen. So you definitely want to just check with your guys to see, if, and get a feeling where they have your back, so, and there's a lot of great companies out there. The money and the terms are similar. And I'd say the most important thing is really building the trust and the relationship, just like any other team member. So I echo what Peter has said.
Makes sense. I see Anthony's popped in here. That normally means we're running a little bit short on time. Anthony, do we have a little time to keep going, or are we at the end?
No, you guys could keep on going. We have two questions. I'm not sure. Would you like to answer them?
Sure. What I want to do is take a quick run around the table here and just get some input on the real estate cycle. Then we'll go to questions here. I'll kind of start you. Real estate is cyclical by its very nature. This has been a great upcycle, but we also have something we've all managed through financial crises and ups and downs. None of us on this call have managed through a pandemic, and you've got everything from incredibly strong demand where people can't even get supplies, to hyperinflation, and we've got low unemployment, a lot of people unemployed, things of that nature. You know, I kind of want to go around the room here a little bit. Scott, where do you think we are in the cycle, and what should people do to take advantage of that and be wary of?
Fortunately and unfortunately, I'm old enough to know. I mean, back in the 80s, when it belly up, I mean, it sort of rebounded. 2005, I used to work for the largest subprime lender in the country, so I know what that's all about. And I see the same type of cycle happening here, where I think the appreciation's going to be cut back a lot in the near future, in next, say, within a year or so. And that's why we're leading a lot of our borrowers towards the long-term rentals, short-term rentals, is that's where I think the money's going to be, cash on cash. We do a lot with bigger pockets, and that's their burst strategy, which we totally believe in. So I think that's where it's going at this point.
Yeah, makes sense. Peter, what would you like to add to that?
I mean, I think it's very difficult to make predictions, obviously. I mean, from, you know, I personally, I think that in the short term, just the supply issue in the, you know, the real estate market, I think will prevent any kind of crash anytime soon, right? I mean, like, I think that we're underbuilt by a couple million units, and, you know, we're building at under 2 million a year, right? So I think builders were so cautious after the last crash that I think they maybe started too late, right? And now it's coming back. But so I think that at least for the next couple of years, just because of that supply and demand, inequality, really, I don't think there's going to be like a major correction. I think Scott is right that the appreciation we've seen since the beginning of the pandemic is not sustainable. So that would most likely slow down dramatically. Affordability could be impacted, obviously, depending on what happens with rates, right? The 10-year keeps kind of increasing little by little. Lots of potential changes, right, in the Fed and everything else. So, I mean, I think the interest rate environment could be potentially volatile over the next couple of months, and that could impact, obviously, rates and affordability. But I don't think that we're in any imminent danger of a major correction in the housing market, as I would say. Super long term, I think real estate always appreciates. I don't know at what rate, and I don't know if there's going to be some ups and downs, but I think short term, I think we're okay. And I think, you know, long term real estate is always a good play. So.
Absolutely. History confirms that. Cory, what are your thoughts?
Well, I got to be careful with this one because I was super wrong in my last when COVID happened. So
Never happened.
Honestly, I have my thoughts, and I think I agree with Peter. I think we're in a different position than we were in the last Great Recession. You know, there's people have more equity there. In the last Great Recession, I mean, there was a lot of dirty loans that were cut, and so we were in a different position. I think our country, or our nation as a whole, there's more equity. People are in stronger positions, and I think if there is a correction, I don't think it's going to be big and drastic. And there's a lot of eyeballs on the problem right now and what's going on, and I believe in that the leadership can figure it out. You know, the guys who are kind of pushing the buttons. I hope so. And like I watch what the Fed is doing all the time, and it's kind of you have to try to read between the lines, because, you know, Jerome Powell, he makes his speech, and of course he cannot say certain words in a certain tone because it could, you know, move markets in either way. It could be bad. So I feel it's a big question mark over my head. All I would say is that our team, and hopefully everyone on the call, is taking this time in the market cycle we're in to just prepare, you know, so that you're proactive rather than reactive, you know, and you're in a position to be proactive rather than reactive. And for us, I think doing things like having a quarterly SWOT analysis on your company or whatever venture you're in, doing a quarterly SWOT analysis, right? So what's your strengths, weaknesses, opportunities, and threats? It can really help you take a step back outside of the day-to-day chaos sometimes, and kind of look at your strengths, weaknesses, opportunities, and threats to help guide you in the right direction with the mindset of, we don't know what's going to happen. But if you're an investor has a lot of capital that they're responsible for, I think it's important to try to look ahead and use tools like a SWOT analysis to help guide you through that decision making.
Definitely makes sense. And I think the theme here is pay attention to the data. Don't be the last one to figure out things are changing. Something else I'd like to add is for people to qualify for these loans, if you're doing a fix and flip project and you want rapid appreciation, in the end, someone has to make enough money to qualify for that loan. If you're doing buying a rental and you want to increase the rent, someone has to make enough money to qualify for that rent. So incomes have to increase commensurate with the appreciation that's taking place, or else people just won't be able to afford the end product, and supply and demand constraints will start to constrain values and rents. With that, we're done with the regular part. We'll go to some questions here. Anthony, do you want to run through the questions? You want me to do it?
I'll actually read them out. Okay, we have 4 questions here. Christina, what about the additions to add square foot to the small multifamily?
Peter, why don't you handle that one? You want to take that one? Someone's saying, hey, what if I'm adding just a small amount of square footage to a multi?
Sure. So I'm guessing that question probably was coming up when we're discussing entitlements and things like that for new construction. So, I mean, it's similar to if you're building ground up. I mean, if you're trying to add something, you know, you still have to make sure that it's within the zoning regulations wherever you're trying to do it. So, you know, usually each zoning is usually town by town, even like township by township. So if you're trying to do that, you still have to make sure that, much like if you're building new, you have to make sure that that falls within whatever the regulations are. Now you can always try to get a variance if it doesn't, but that you may or may not be successful. So that's one of those things you don't want to gamble on, right? You want to make sure that whatever you're trying to do is allowed before you take on the deal.
Makes sense. Anthony, what's our next question?
What banks are lending for STR?
STRs in this case are short-term rentals. Scott, do you want to handle this one?
Sure. I mean, I know everyone on this call is lending on it. That's pretty much where we're at. I mean, like I said before, our short-term rental programs, they're in the 4s right now, you know, depending on, we just look at credit score. We don't look at bank statements. We look at DSCR. I know Templeview has a product, Builders Trust does, and Keco does, the 3 of us. So those are the banks I know of.
The 3 people, the 3 firms, the 4 people on this call.
Just missing one more from Mount Rushmore.
Absolutely.
One more from Mount Rushmore and we're set.
Yeah, thank you, Scott.
Yeah.
Brian, I joined late. Can we get the names of the companies of all the panelists? Yes, Brian, I'll answer that. Temple's team will be sending out all the names, all the contact information on Monday, possibly tomorrow. That's correct. Tim, on deals where I buy a distressed property with a fix and flip loan to do the repairs, then I go back to the lender for a long-term financing. I want to get as much of my money back as possible with long-term financing. What factors will increase the amount I can get on the long-term financing?
So Corey, I'm going to land that one to you. It was a little bit of a long question. So somebody did a rehab there, they're done with that, and now they want to get as much money out of the long-term loan as possible. How would they do that, Corey?
Well, so what affects like the leverage and the rates? I mean, things like credit score, DSCR, and Scott, if you can help me out on this one, since you know the.
Pretty much, yeah. I mean, after they've done the repairs to it, the after repair value, you're going to see what we can do. Like if it's a purchase, we go 90% of the purchase, 100% of the rehab, and up to 90%. I mean, I'm sorry, up to 75% of the ARV. But when you're doing it, we can go up to 75% of the cash out for a cash out refi, or rate and term, we can go up to 80%. So if you built up equity in the property, we'll take the as is, and we'll give you 80% of that to go into a long-term rental or short-term, you know, but mostly a long-term rental at that point, where the rates are starting in the 4s.
There you go. Boom.
Thank you,
Anything else
Scott.
for us, Anthony?
Yeah, you have a question over here in chat. I'm sure all you guys are going to say yes. Furman, a new investor, but with great credit, and a realtor needs a very good lender relationship. Next move for me. Reach out to you.
I'll take that one again. Hey,
Yeah.
we have the emails for everybody. We're going to be sending out the contact information. These 3 firms, these 4 people, this is exactly what we do, is provide that type of financing. And it's not just the financing. The theme of this whole webinar has been the added benefit, the expertise that both the people on this webinar and the staffs that we employ can provide. We're eager to answer these questions. We love it. This is what we do, and we will be sharing our contact information so you can reach out.
Guys, this concludes our webinar. Again, you will, like we kept on saying, you will get a list of all the information, including the video, and the team of Temple will be sending it out to everyone. And there were many people that did sign up for this webinar. So guys, thank you. Doug, Peter, Scott, Cory, a real pleasure.
All right.
Thanks
Thank you,
everybody for
everybody.
joining. Thanks for
Thank you.
hosting, Anthony.
All right.
Thank you.
Have a happy
Thanks
holiday,
so
guys.
much, guys.
Take
This
care.
actually
Bye.
concludes. Take care, everybody. Thank you.
Bye.